Hello and welcome to Equitile Conversations. I'm Gerald Ashley, and as usual, I'm joined by my good friend and colleague, George Cooper. And today on the menu, we've got really what I think is going to be a very big topic for people involved in markets and just people generally. And that is, of course, inflation. Now, George, we've sort of talked around a lot of the topics about inflation, maybe without naming it and getting down into the detail of what's going on. So, once again, as usual, I'd ask you to set the scene and what are current prospects for inflation, obviously here in the UK and obviously globally important in the US. And I sense you've not got good news.
Um, yeah, I think that's fair, Gerald. I think, first it's worth focusing on inflation at the moment because we've got a lot of things going on in the markets and in the economy that suggest that inflation is about to tick up. In fact, it's more than ticking up; it's surging, and we're seeing the symptoms of this already in the bond markets. We're getting a lot of press coverage about this. But if we look at particularly the 30-year bond yields, which are the most sensitive to inflation, we've got in the US, 30-year bond yields have gone above 5%. In the UK, they're nudging towards 6%. I'm trying to find the chart here as we talk about it, but they're surging faster in the UK than they are elsewhere. And this is going to be a problem going forward because we've got a lot of debt outstanding. Economies around the world are very heavily indebted. US debt to GDP is now above 120%. This was the sort of level that a few years back we were panicking about Greece's debt. This sort of level, well, the US is there, the UK's there as well. And a lot of this debt, as it rolls over, a lot of it was issued years back when interest rates were very low. Now, as it matures, it's going to get rolled over into much higher yielding debt, which means that the governments around the world are going to be paying much more of their tax income
Yeah.
to bondholders and have less money to spend.
To sort of set the scene politically, people are saying, "Oh well, this is because of the war in the Gulf, and wars are very expensive, and it'll all pass once if the Gulf settles down into whatever form of settling down. This will all fade away." But you think it's more embedded than that?
Yeah, I do. I do think there's a process that happens in the economy, which is once inflation becomes normalized, once you've had it, you've once you've been used to it for a few years, it becomes easier for consumers to accept that prices do naturally rise. And of course, producers always want to push up their prices if they possibly can. So it has been normalized, and that's an important dynamic. But aside from just the normalization of inflation, we've got now with the energy shock that's coming out of the US-Iran war, we've got the immediate effect of that energy shock, which is probably being understated by the markets at the moment, and that's because we haven't felt the full brunt of the oil shortage because governments have been releasing strategic reserves so far.
It sort of feels like a phony war almost. The real sort of shooting metaphorically in finance hasn't happened yet.
Yeah, there's a process where you get a sort of delayed response. I think first because we are literally burning through the oil that had been in transit at the start of the war, and it takes a few months to get oil out of the Gulf and into the rest of the world. So there's naturally a sort of 2 or 3 month grace period where the oil shortage doesn't hit the economy. And then in addition to that, we've had releases from strategic reserves. As all of that starts to fade, we're going to start getting the real shock, I think, more or less from now on. In addition to that, we've got the oil products, which is, the chemicals, the fertilizers, things like that, which A lot of people, I'm not an expert on this, but a lot of commentators are saying this is already impacting the planting plans of farmers around the world,
Yeah.
which suggests there'll be food shortages 12 months' time. So this is what gives you potentially a rolling inflation shock from this that lasts more than just a few months. It goes into several years.
Right. Now, I mean, if I took no interest in markets and took no interest in economics, which I think the vast majority of the population would be in that camp, I'm slightly being sold a story of inflation because of this war, but the government are going to manfully get on top of it, and that the Bank of England has got this 2% target, which is obviously way out of court at the moment. But don't worry, because these guys are going to get it back under control. We will get back to normal. If I take my sort of view, or indeed your view, that a more cynical view, is to a degree, inflation is not a problem for governments.
Well, this is one of the great fibs, if we're being generous, that is collectively told by finance textbooks, central bankers, and governments, and that is that they all try to keep inflation down. The reality is, actually, the monetary system is designed to create inflation, because inflation is a very convenient thing for governments. Inflation is effectively another form of tax, but it's a tax that a government can apply without legislation.
Yeah.
So, and without most people knowing it. In fact, a lot of people actually sort of experience inflation in a sort of positive way. They see their house prices going up.
Yeah.
They see their investments going up, and they kind of like that. They see their salaries going up. So inflation is maybe one of the least unpleasant taxes, and they need to keep it going.
One's tempted to say, of course, if it gets to a critical mass and runs away, and then indeed the game is up, because you talked about long-dated bond yields, and at some point bond yields will move to a point that there is no buyers, whatever the price is. Now, I mean, I don't know if we're going to have a go at guessing where, let's say, the gilt market suddenly doesn't want to buy government bonds. It's probably 200 or 300 basis points away, maybe even 400. But once this engine gets rolling, it can be quite difficult to stop from a government's point of view, isn't it?
Yes. Well, essentially, the bond markets can work in two different modes, which is really important to understand here. The first mode is if the bond market thinks that you are a sound borrower. In other words, they think that you've got the capability of repaying your debt. Then, as yields go up, the investors will see that as attractive. They'll say, okay, we're going to get a higher yield on our debt. We will be willing to lend because of those higher yields. But if you flip into another mode where the yield is high enough that the lenders start to worry that you can't afford to pay those yields, then the higher yield actually starts to signal a greater default risk. So the higher the yield goes, the lower the demand for the debt.
So the sentiment actually flips around, and in the common parlance, there's a tipping point somewhere.
Yeah, this is very common or has been very common in the past, in the different ways that the markets responded to what we used to call emerging market economies versus developed market economies.
Yeah.
Bond yields went up in developed economies. Generally, there was more buyers for the debt. But when bond yields went up in emerging economies, like, for example, Turkey, Zimbabwe, Argentina, people have started to say they can't afford these yields. So we really don't want the debt at this point. Now, I think the issue here is that the debt sustainability levels of the developed economies like Britain, the US, Europe, Japan for that matter, they've now flipped into the emerging market zone. The debt level is too high, it's unsustainable, and the bond markets are beginning to panic.
Which is an extraordinary state of affairs, really. That I remember we had a guest on last year talking about how the United States could, by some criteria, could be judged as an emerging market.
Yes, there's other symptoms of it other than just the debt load. You know, we've got Donald Trump going to China, and interestingly, his second visit to China without it being reciprocated. But he's going to China and he's trying to sell oil and soybeans to the Chinese.
Yeah.
These are commodity exports. These are traditionally emerging market exports. And on the other hand, the emerging market economy, China, I say that tongue in cheek because it's patently not true anymore, they're selling the high-end manufactured goods back to the West. So there has already been an inversion.
Yeah, I mean, this is quite remarkable. Is there any light at the end of the tunnel here? What would maybe suppress this scenario a little bit? I'm going to struggle to think of anything, but the only thing I can think of is fairly radical government cuts. But there's two problems with that, as far as I can add. Spending cuts. There's two problems with that. First, politically, and secondly, if you really go for it, you risk a downturn in the economy.
This, I think, brings us to an important point, Gerald. So the challenge here is if you've already got a high debt load and you're spending beyond your income, and you've been spending beyond your income for a long time, then the economy has become used to that fiscal stimulus.
Yeah.
If you suddenly turn the fiscal stimulus off, then just mechanically, year on year, you'll go into a recession. And as you go into the recession, that will create a deflationary wave.
Yeah.
And that's where you start to get into a debt deflation trap, which is where Japan has been. Japan's just coming out of it now. It's where Japan from the early 80s onwards, I guess, was in this debt deflation trap for decades. And the challenge with that is it's not easy to get out of it once you're in it. So trying to avoid that is maybe why we're seeing some very strange policies at the moment. In other words, what I'm saying is governments have done a lot of things over the last 5 or 6 years. They've done, lockdown with huge stimulus. Donald Trump's introduced trade barriers and tariffs, which create inflation. The ICE program in America trying to turn, or successfully turning, net immigration into net emigration. That reduces the labor force, which creates inflation. The Ukraine war, the Iran war, with the energy shocks that they've generated, they create inflation. There's a whole series of policies that has happened over the last 5 or 6 years, which have all been very inflationary. I think, although all of those policies have been done for other reasons, taken together, that set of policies does show, let's say, a tolerance of inflation.
Or a desire not to mix metaphors here a little bit, but not to experience cold turkey, to not actually try and dry out.
Yeah, exactly. So what I'm saying here is I think the tolerance of inflation is now so embedded that you could actually go a step further and say that, no, inflation is now a government objective. And that is because they need the inflation to allow them to pay for the debt that they've already incurred, but also because their deficits are so big that they can't service the deficit without the inflation. And remember, inflation is a closet tax, as we talked about earlier.
Being ever the cynic again, it makes me think the thing of the Bank of England writing a letter to the Chancellor because it's over 2% is, at best, it's pantomime. At worst, it's nonsense. So another angle on this would be to say, well, of course, the way out of all of this is to somehow promote economic growth. And we had Doug McWilliams on from the Growth Commission just before Christmas, and he outlined a good half a dozen policies that could be implemented over time that would certainly boost growth pretty much in any open economy, certainly desperately needed in the UK. But politically, there seems no desire to get away from a very top-down sort of control view of the economy.
I don't see anywhere in the West, in the developed economies, I don't see anywhere where there is that sort of deregulate, liberalize, get back to allowing private enterprise to create growth. We've actually got on both left and right, we've got very interventionist mindset. I mean, Donald Trump is he's very much not the heir to Reagan.
He's not a free trader, is he? Not at all.
He's not a free trader. He's not a free markets person. He is intervening in the US and the global economy in all sorts of ways. And, it's fascinating. We've just had the local elections in the UK where very clearly the Reform Party was the winner in that, with a big surge in seats. And they're also not a free trade party. They also want to do lots of stuff. So there just isn't this on the menu of the political offerings. There isn't an item that is pro-growth. There's nothing on offer.
I think the language is interesting. When Trump announced that the US government had invested in Intel, taken a minority stake in Intel, that could have been characterized as part nationalization, but of course isn't. And as you say, there seems to be a lot of linguistic and terminological sort of acrobatics going on here. But the truth of the matter is that what one may call a free market economy, the direction of travel for all the G7 is not that way, is it?
No, it's not, and that's why I think the inflation issue is now embedded. I think what's going to happen is we're going to go into what I'm calling the third wave, which is it's a reference to a chart that a lot of people will have seen floating around the internet, which is comparing the recent couple of sort of spikes in inflation to those that happened in the 1970s, between the period of basically about 1967 up to about 1982. There was 3 waves of inflation, with each one being bigger than the last, until the one that peaked about 1980 in the US, inflation peaked at about 15%.
Yeah.
I think the analogy is that the second wave of inflation that in that series was our wave of inflation that came after lockdown, when lockdown was released. That process has sort of faded now. Inflation's dropped back. So we're in the sort of 3.5-ish sort of percent. But now it looks like this new energy shock is going to take it higher. And I think we'll follow the same trajectory more or less as we did in the 70s. And that suggests that we're probably on path to get an inflation rate peaking in a few years' time at perhaps as high as 9%, if it follows the same pattern.
This scenario is doing nothing for our reputation of always being rather pessimistic about things. One way of looking at this, or at least I'm more pessimistic than you, I think, in fairness.
I can see some optimism in this, but carry on, Gerald.
Well, maybe another element to all of this, again, looping back to a guest we had on in the autumn, Helen Thomas, who said from a political point of view that this will just keep rolling along until there is a big enough crisis to, politicians actually do have to do something. But would you think that we're not really anywhere near the crisis level yet?
No, I don't think we're in the crisis level. I think this is exactly the point. I think we've got to go through this next wave of inflation to get to the point where it becomes clear that the inflation is negative for the economy. Because, as I said, there's a lot of aspects of inflation that people rather like. Governments like it because it makes life much easier for them. People tend to like it because their wages go up. They see the value of their houses go up, things like that. It's only when you start to see the negative effect of, oh, hang on, inflation's going up, but the value of my house isn't going up anymore because interest rates are too high. And interest rates are too high, which is stopping companies from investing, which means the job opportunities are not there. So it's when you get to that second round effects that are negative, then you start to change the political climate. And that's when perhaps we'll get some grown-ups coming back into the political world, and we really don't have any at the moment, who will be able to respond to a change in the public mood, which is to accept that something needs to be done about this.
Yeah, I think that's a reasonable thought. Looking at our own sort of parish of investment and investment opportunities and maybe minefields to avoid, it's hard to make a case for being invested in bonds at all now, is it?
I think I've used this line before on this podcast, but I call them certificates of charitable giving. You really don't want to be involved in the bond market at this point, because if this third wave of inflation does come about as we're discussing, and it does peak at something like 9%, well, there's no bond yields around at the moment that are anywhere near that, at least in government bond circles. So that means that you're going to incur a real loss on those bonds. So that's not, to say the least, that is not my favorite investment sphere at the moment.
Which also brings back to another discussion we had in the past, which is assessing investment performance, looking at benchmarks. I know you've been a strong advocate, and it's hard to argue against it. I think you're right, that the only benchmark that matters is the inflation rate. Now, you would like to have a basket of assets that is growing on a total return basis of greater than the annual rate of inflation. There are a couple of twists and turns in that, aren't there? Because different people have different levels of inflation. All these indices are flattering to deceive. We're seeing, an absolutely vertical climb in the S&P 500 over the last few weeks, with tech stocks, blasting off literally into space, or will be with Elon Musk's latest vehicle. But is it time to actually say, look, the only thing that really matters, and this is going back to the 1960s and Harold Wilson, is the pound in your pocket. And if you're not beating inflation, you're losing.
I do take that view. I think that's the purpose of investing. The purpose of investing is to grow your wealth in real terms. That means above inflation. Now, at the moment, of course, the S&P is doing that phenomenally well, as you said, over the last few weeks. It's surging relative to inflation, but there is a nagging doubt as to whether that's really sustainable, because although the multiples are surging, which is what's driving the asset prices ahead, it's getting more and more difficult to see that the earnings are going to continue to surge in the way that's needed when we've got new costs hitting the economy, and the new costs being higher energy costs and higher interest rate costs. Especially on the energy costs, we've got to remember that the reason the S&P is surging is basically because there's another wave of euphoria over data centers and artificial intelligence. But at the same time, you've got people rightly saying, well, if these data centers are going to work, we're going to need 1,000 times the amount of energy we've already got. Sorry, that's just not going to happen.
That's self-limiting in a way, isn't it?
Yeah, and it's not going to happen. And the energy costs are surging. So the economics of these data centers are actually deteriorating quite rapidly. So I have some concerns on that front, but that's probably one for a separate podcast.
Given this a good round the parish, I think, in terms of inflation, we come to book recommendations. I'll get mine out the way fairly quickly. It's another, I'm afraid, rather large tome. I'm just thumbing through here. It's some 700 pages, this one. It's called A History of Money from Ancient Times to the Present Day, by Professor Glyn Davis, who I think died a number of years ago. My edition is the original edition, actually, back in, I think it's 95 or 96, and it has been updated by one of his close collaborators a few years ago. In a sense, it's a period piece because it stops at the very point that digital money starts to look as if it might come into view. But it is the most fascinating. It's a reference book in a way, rather than you read it from one end to the other. But there's all sorts of things about debasement of money through inflation with Spanish gold and problems in medieval trade as a result. The Romans had loads of problems exactly the same. And it also explains how fractional banking got going. So there we are, A History of Money by Glyn Davis.
That sounds good, actually. I'm surprised I haven't come across that one before, Gerald. I'm definitely going to get that book. So for me, I've got a recommendation, which is a book I read recently, which is really fascinating. It's by Simon Winlow and Steve Hall. Professor Steve Hall is quite active on Twitter, so you can follow him. And the title of the book is The Death of the Left: Why We Must Begin from the Beginning Again. This book, it is very much written from, I would say quite a hard left perspective. But what I found really interesting about the book is it's an analysis of how the left sort of lost the plot. And I've got a lot of sympathies with the analysis of the book. And particularly, it explains how the left moved from being essentially a group of people who were interested in the welfare of the less well off. In other words, they were interested in social inequality, and how they sort of completely abandoned that issue and changed to focusing on other forms of perceived inequality, racial inequality, gender inequality, and essentially how they gave up on wealth inequality and became obsessed with identity politics. There's a very good explanation of how that came about and why it's a bad idea. So I do encourage the readers to read this book. It is very interesting, and I think the process they describe is perhaps responsible for the deterioration in the quality of politics generally. Because if you think of politics as a sort of tennis match between the left wing and the right wing, if you've got one side of the tennis match suddenly loses form, can't return the ball, then the other side is also going to lose form. And that's sort of what happened. The left has literally lost the plot, and that's not providing the tension or the motivation for the right to raise its game.
So it's a race to the bottom in terms of ideas and new ways of thinking, maybe.
Yeah, exactly that. So that's my recommendation for this podcast.
Well, I guess once again I've looked at history, and you're really, in a way, maybe looking at future policy ideas. That's it from both of us for today on inflation. We will be back again next month, undoubtedly. And until then, thank you very much and goodbye.
Thank you, Gerald. Thank you.